What if the most important market development this entire weekend had nothing to do with central bank policy, nothing to do with a Federal Reserve communique, and nothing to do with anything whispered between institutional traders on a trading floor, but instead arrived through a social media post written in contempt by a senior Iranian government official? And what if that post, laughed off by most financial commentators as political noise, is actually the clearest key we have to understanding why silver is sitting at 80.71 per troy ounce right now, and where it may be heading next? Here at SilverDispatch, OG Peter doesn't do conjecture dressed up as conviction. What follows is a structured breakdown of publicly verifiable data, the kind of data that doesn't file a press release, doesn't appear on your ticker, and doesn't show up in the headlines. It simply records what physical buyers do, session by session, when they decide to show up and demand real metal. Let's begin with the political signal. Mohammad Bagher Ghalibaf is the Speaker of Iran's parliament, and he is not a peripheral figure. Analysts consistently describe him as a consequential voice inside the Islamic Republic's security establishment. When the United States transmitted a one-page framework document through Pakistani diplomatic channels, proposing a pathway to reduce hostilities and progressively reopen the Strait of Hormuz, Ghalibaf's response was not cautious or measured. It was openly dismissive. He labeled the entire affair Operation Foxios, a constructed portmanteau, merging the French word for false with the name of the outlet that broke the story. He then followed that with a second post declaring that Operation Trust Me, bro, has failed. This is not the language of a man preparing to endorse a diplomatic resolution. This is the language of a man signaling, through the most public channel available, that any agreement requiring parliamentary ratification faces a far more complicated road than the headlines suggest. However, while the geopolitical press analyzed those phrases for their diplomatic implications, something far quieter was unfolding inside a COMEX warehouse in New York. Something that, based on publicly available CME Group data, has been occurring with remarkable consistency for the better part of 6 months. Physical silver has been flowing out of the COMEX registered inventory pool at a pace that commodity analysts are describing with a word they reserve for genuinely unusual market conditions: stress. This is where it gets interesting. Because the vault doesn't have a social media account. It doesn't mock peace deals. It doesn't describe diplomatic frameworks as wish lists. It simply records what physical buyers do. And for 6 months, according to the public record, they have been showing up. Stay with me. Let's talk price context. Because price without context is just a number, and in commodity markets, context is everything. Silver closed this week at approximately 80.71 per troy ounce, according to Trading Economics data. That represents a gain of nearly 147% over the past 12 months. Gold, per Fortune's tracked spot data, sits at approximately 4,715 per ounce as of May 9, 2026. Run those two numbers against each other, and the gold-to-silver ratio comes in at approximately 58.1, against a modern long-term average that analysts broadly cite around 70.1. That compression matters. It is not a footnote. When silver outpaces gold on a relative basis, the historical pattern has typically reflected tightening physical supply conditions, rather than speculative momentum alone. That distinction is important, and we will return to it. Now consider the broader environment in which that price level has been achieved. Since late February, when the escalation between the United States and Iran effectively closed the Strait of Hormuz, energy markets have experienced historic turbulence. Oil has tested and breached $100 per barrel. Inflation expectations have intensified. The Federal Reserve Bank of Chicago's Austin Goolsbee warned publicly this week that inflation has not continued its path toward the Fed's 2% target, that it has, in fact, accelerated since the onset of the conflict. The conventional analytical response to that environment is straightforward. Rising inflation expectations create pressure for higher interest rates. Higher rates make yield-bearing assets more attractive relative to metals that generate no income. A strengthening dollar makes dollar-denominated commodities more expensive for international buyers, typically suppressing demand. Both of those forces have been present simultaneously during this period. Silver closed above $80 anyway. That deserves more than a passing observation. It deserves structured examination. And the structure that matters most here is the COMEX registered inventory. Specifically, the growing gap between what is sitting in that pool and what has been physically leaving it. But here's a catch most retail investors miss. Not all COMEX silver is equal. There is a critical distinction between registered and eligible inventory, and confusing them is one of the most common analytical errors in retail precious metals commentary. Eligible silver is metal stored in COMEX-approved vaults that meets exchange purity and bar standards. It is present in the system, but it is not automatically available for futures delivery. The owner must make a deliberate decision to register it, and that decision does not happen automatically, regardless of how high delivery demand climbs. Registered silver carries a warehouse warrant, a transferable title document making that specific metal immediately deliverable against an outstanding futures contract. When commodity analysts discuss delivery pressure in the COMEX system, they mean registered inventory, not eligible. The eligible pool represents a theoretical buffer. The registered pool is the operational reality. And the operational reality has been quietly extraordinary. Here are the delivery figures, drawn from publicly available data, tracked through the CME Group's own warehouse reports, and compiled by commodity monitoring services. Every one of these numbers is independently checkable by any investor with an internet connection. According to available tracking data, approximately 202 million ounces of silver were delivered through COMEX futures settlement across 5 complete months from December 2025 through April 2026. December reportedly saw approximately 64.7 million ounces. January, approximately 49.4 million. February, approximately 25.2 million. March, approximately 46.1 million. April, approximately 16.6 million. May delivery notices through the most recent available data have added an estimated 25 million ounces, bringing the approximate 6-month running total to roughly 227 million ounces. Now set that figure beside the current registered pool, approximately 79.8 million ounces. Roughly 3 times the current registered inventory has reportedly been delivered through the exchange in under 6 months. Let that ratio sit in your mind before you proceed. But there's a catch. The COMEX delivery system has not frozen, has not failed, and has not produced a formal shortage declaration. The eligible pool has served as a continuous backstop, with metal converting from eligible to registered as delivery demands have required. What the data describes is not a broken system. It describes a system operating under conditions that exchange-focused commodity analysts characterize as approaching moderate stress. Now add the structural demand backdrop, because a single exchange's inventory data, viewed in isolation, is only part of the picture. The Silver Institute's World Silver Survey 2026, published April 15th, projects a global silver supply deficit of approximately 46 million ounces for this year, and describes this as the 6th consecutive projected annual deficit. Since 2021, cumulative drawdown from above-ground global silver stocks has reached approximately 762 million ounces, consumed primarily in industrial applications, solar panels, electronics, medical devices, where recovery at typical market prices is not economically viable. Then consider China. According to Chinese customs data reported by Reuters and multiple commodity services, China imported approximately 836 metric tons of physical silver in March 2026 alone, described in those reports as a record single-month import, representing approximately 173% above the 10-year seasonal average for March. The Chinese government has classified silver as a strategic material since January and restricted exports to a set of government-authorized companies. The Shanghai Futures Exchange has been showing silver trading at a premium to international benchmark prices in the range of 12 to 17% in recent months. And Turkey. According to Turkish customs data, Turkey imported approximately 273 metric tons of physical silver in January 2026, the highest single-month figure in Turkey's recorded history. When a major refining hub connecting European, Middle Eastern, and Central Asian supply chains books metal at that volume in a single month, the working analytical assumption is that its institutional base has made a forward-looking judgment about availability that is worth taking seriously. These are the structural demand signals. None of them were created by Iranian parliamentary commentary. None of them would be fully reversed by a diplomatic agreement. Intellectual honesty requires acknowledging the strongest counterarguments before offering a framework. A structural thesis that cannot articulate the case against itself is advocacy, not analysis. The structural silver case has legitimate counterweights. If central banks accelerate rate hikes in response to persistent inflation, the headwind for precious metals intensifies. If sustained energy price shocks slow global economic growth, and credible economists argue they eventually do, industrial demand projections weaken. If the COMEX registered pool is replenished through eligible to registered conversions that current data does not yet reflect, the delivery stress picture changes, and structural arguments about silver's physical supply have been made at various intervals over the past decade, without always resolving on the expected timeline. The data is the data. The interpretation remains genuinely contested. What is not contested? JP Morgan's published 2026 full-year silver price forecast sits at approximately $81 per ounce. When a major institutional price target and the current spot price are sitting within $1 of each other, experienced market observers typically read that not as a signal that the move is finished, but as a signal that the institutional consensus has caught up to where physical market pressures have been building. Three broadly plausible scenarios exist for what Monday morning could bring. The first, and based on the absence of a formal Iranian response as of this writing, the most probable, is a weekend that passes without decisive development in either direction. No signed agreement, no formal rejection, no new military exchange that reshapes the risk picture. In that environment, silver could open Monday near its current range, with the first hour behavior around $80, which served as resistance for approximately 8 weeks before this week's move, becoming the key technical reference point. Analysts cite $80 to $84 as the next resistance zone. A measured move target derived from the pattern that broke this week has been cited in the range of $95 to $104, though technical targets are better treated as zones of potential interest than certainties. The second scenario involves new military activity or a formal state-level rejection from Tehran. In that case, oil markets could reprice sharply at Sunday's open, and silver could test the $76 to $78 range in early Monday trading. Structural analysts note that each previous paper price dip during this period has been followed by increased physical delivery standing, buyers choosing to take metal at lower paper prices. Whether that pattern holds is unknown. The third scenario is the one that could produce the most confusing price signal, a formal Iranian response that Washington accepts as a ceasefire framework. Oil falls. Inflation fears ease. Silver potentially sells off several dollars on what traders call a peace premium unwind. The financial press describes this as silver falling on good news. Structural analysts respond that a diplomatic agreement changes none of the underlying supply dynamics. Not the registered pool, not the 6-year deficit trajectory, not the Shanghai premium, not China's strategic reclassification. The four numbers worth monitoring into Monday morning. The Sunday night Brent crude opened at approximately 6 MAUC Eastern. The COMEX registered silver pool in Monday's CME Group warehouse report. The dollar index Monday morning, and the Shanghai Futures Exchange overnight premium on silver. Any movement outside the recent 12 to 17% range would represent a potential shift in Chinese physical demand signaling. This is OG Peter at SilverDispatch. Drop a comment right now. Tell me what silver is showing on your screen as you watch this. Tell me what you hold: physical, ETF, mining shares, or nothing yet. Tell me which of these 3 Monday scenarios you think is most likely and why. This is for education and discussion only, not personal financial advice. I'm sharing a framework for thinking through the data so you can make your own informed decisions with your own money and your own risk tolerance. Hit subscribe and the notification bell. When Monday's session opens, you want a framework already in place, not a headline arriving first.